The global silver market is facing its most dramatic transformation in decades as China's new export restrictions, implemented January 1, 2026, collide with record-breaking prices and the deepest supply deficit in modern history. With silver trading around $76.77 per ounce today, down slightly from recent highs near $82 but still up over 150% from a year ago, the white metal has become ground zero in the escalating battle over critical resources. Starting January 1, 2026, China is implementing new export restrictions on refined silver that are already sending shockwaves through global markets. Under the new policy, only large state-approved companies will be allowed to export silver, and only after obtaining special government licenses. The requirements are stringent. Companies must demonstrate annual production capacity of at least 80 tons of silver and maintain verified credit facilities exceeding 30 million. Only 44 Chinese companies will be authorized to export silver during the 2026-2027 period, effectively sidelining hundreds of smaller and mid-sized exporters who have historically supplied global refiners and industrial users. The implications are staggering. China currently controls between 60% and 70% of the world's refined silver supply. What Beijing frames as administrative reform, markets are experiencing as a strategic chokehold on one of the world's most critical industrial metals. China's move doesn't merely tighten an already constrained market, it could break it entirely. For the past 5 consecutive years, global demand has exceeded total supply, creating structural deficits that have quietly drained inventories worldwide. The numbers tell a stark story. In 2025, global mine supply was estimated at 813 million ounces, while total demand crossed 1.24 billion ounces, marking the 5th straight year of deficit. This represents a shortfall of over 230 million ounces, equivalent to Mexico's entire annual production, the world's largest. The deficit isn't improving. The silver market remains in a multi-year structural deficit, with demand exceeding mine supply by roughly 200 million ounces in 2025. Analysts forecast the imbalance will persist through 2026 and beyond, driven by forces that cannot be easily reversed. The physical evidence of stress is unmistakable. COMEX-registered silver stocks have plummeted 70% since 2020. Shanghai Futures Exchange warehouses hold their lowest silver levels since 2015. Inventories in key hubs such as London, China, and the US have fallen to multi-year lows. This isn't speculation, it's depletion. The market is consuming more silver than the Earth can provide at current mining rates, and the buffer that once absorbed shocks has vanished. Unlike most commodities, silver operates under unique constraints that prevent traditional supply responses to price signals. Approximately 75% of silver comes as a byproduct of mining other metals, primarily copper, zinc, and lead. This means even as silver prices have more than doubled, production cannot simply ramp up to meet demand. New mining projects face a brutal reality. They require 8 to 12 years from discovery to first production. Ore grades are declining globally. Capital investment in silver exploration has been inadequate for over a decade. The pipeline for new supply is essentially empty, and there's no fixing it quickly. While supply stagnates, demand is exploding, and not from speculators. Nearly half of global silver consumption now comes from industrial use, particularly in solar panels, electric vehicles, electronics, and increasingly in AI-linked hardware. Solar photovoltaic manufacturing has become the single largest consumer, accounting for over 20–25% of annual global silver demand. The energy transition isn't slowing, it's accelerating. Electric vehicle production surged in 2025, with each vehicle requiring significantly more silver than traditional cars for sensors, battery management systems, and power electronics. The AI revolution adds another layer. Data centers, semiconductor manufacturing, and advanced computing all require substantial silver inputs. These aren't cyclical demands that fade with economic downturns. They're structural shifts in how the global economy functions. An unexpected player has emerged in this drama. India imported over 170 million ounces in the first 10 months of 2025, with a sharp spike of more than 2,600 tons in September and October alone. This surge reflects both robust retail demand and rising industrial consumption, particularly from the solar and electronics sectors. India's buying has helped drain London's silver vaults, intensifying the global shortage and contributing to price volatility as regional markets compete for limited physical metal. Silver's performance has been nothing short of extraordinary. The metal climbed from around $29 per ounce in January 2025 to briefly touch $82 in early January 2026, a gain of over 180% at the peak. Even after recent consolidation, silver remains near $76.77 per ounce as of today, January 16, 2026. Analysts are scrambling to revise forecasts upward. Bank of America has raised its 12-month target to $65. BNP Paribas suggests silver could reach $100 by year-end 2026. Some particularly bullish analysts see potential for $175 or higher if the supply crisis intensifies. Tesla CEO Elon Musk has publicly warned about the implications, noting that this is not good. Silver is needed in many industrial processes, underscoring concerns among manufacturers whose operations depend on reliable access to the metal. China's silver export controls mirror its strategy with rare earth minerals, where export restrictions created supply chaos and drove prices dramatically higher. By requiring licenses and limiting approved exporters, Beijing transforms every ounce of exported silver from a market transaction into a political decision. This isn't just about economics. Silver has been designated a critical mineral by the U.S. government due to its indispensable role in solar cells, semiconductors, and advanced electronics. China's controls effectively weaponize this dependency, particularly targeting sectors central to the global energy transition and technological innovation. The licensing framework allows for graduated escalation, from reduced quotas to complete prohibitions, depending on geopolitical circumstances. Markets now trade not just on supply and demand fundamentals, but on political temperature and diplomatic signaling between major powers. Perhaps the most alarming development is the growing disconnect between paper prices on futures exchanges and physical metal premiums. Physical silver is commanding significant premiums over spot prices as buyers scramble to secure actual metal rather than financial contracts. This divergence raises profound questions about price discovery. If physical scarcity continues to intensify while futures markets remain relatively liquid through paper trading, the traditional pricing mechanisms could break down entirely. Some analysts warn this could lead to a liquidity crisis where contracts cannot be settled with physical delivery, forcing a painful repricing of the entire market. For investors, the landscape has fundamentally shifted. Silver's dual role as both precious metal and critical industrial input creates unique dynamics. The metal now trades on industrial fundamentals as much as monetary policy and safe haven demand. Experts recommend diversified exposure through physical holdings, ETFs, and mining equities, with position sizing that accounts for silver's notorious volatility. Dollar-cost averaging into positions makes sense given the potential for sharp corrections even within a structural bull market. But the consensus is clear. The fundamental case for higher silver prices remains compelling. Structural deficits, explosive industrial demand, accommodative monetary policy, and geopolitical supply risks are all aligning in silver's favor. As 2026 unfolds, several factors will determine silver's trajectory. Federal Reserve policy and interest rate decisions will influence investment demand. The strength of the dollar affects commodity prices broadly. Economic growth rates will impact industrial consumption, though the evidence suggests secular trends in renewable energy and electrification are powerful enough to sustain demand even through modest slowdowns. Most critically, how China implements its export controls will shape market access and price volatility. Any tightening beyond current levels could trigger sharp price spikes. Conversely, Beijing could use export approvals as diplomatic leverage, adding another layer of uncertainty. What's undeniable is that the era of cheap, abundant silver has ended. The market is fundamentally repricing the metal from an industrial commodity to a strategic resource. Whether this evolution continues smoothly or erupts in crisis may depend on decisions made in Beijing as much as supply and demand fundamentals. For now, with prices near $76-77 per ounce and inventories still draining, the great silver squeeze of 2026 shows no signs of easing. The question is no longer if silver will remain elevated, but how much higher it might go. And what breaks first, the supply bottleneck or the market structure itself?